Welcome to Stock Smarts. Today, we're breaking down the big question on every investor's mind. Why do markets, stocks, Bitcoin, and crypto react so negatively when interest rates stay high? The Federal Reserve recently signaled that they won't be cutting rates anytime soon. This announcement sent shockwaves across markets, causing a significant drop. But why does this happen? What's the connection between interest rates and market behavior? Stay with us as we explain it all and what it means for your investments. Let's start with the big news. This week has been a roller coaster for the financial markets. The Federal Reserve decided to keep interest rates unchanged, a move that was widely anticipated by analysts. However, they made it clear that rates would remain high for a prolonged period, which caught many off guard. Here's why that matters. Many investors were expecting rate cuts to stimulate the economy and boost growth. The Fed's signal dashed those hopes, emphasizing their priority to fight inflation, even at the cost of slower economic growth. This news caused widespread market declines. Stocks fell sharply as growth prospects dimmed and investor sentiment turned negative. Bitcoin and other cryptocurrencies, which often mirror speculative investments, also tumbled, reflecting the broader market's anxiety. So, what's the connection? Why does the market react so strongly to high or sustained interest rates? It's all about the cost of borrowing money. Higher rates mean higher costs for businesses and consumers, which can slow down economic activity. Here are the main reasons high interest rates cause markets to drop. Higher borrowing costs. When interest rates are high, borrowing becomes more expensive. This affects both individuals and businesses. For individuals, higher interest rates mean higher mortgage payments, more expensive car loans, and increased credit card debt. For businesses, the cost of financing new projects or expanding operations becomes prohibitive. This can lead to a slowdown in growth and innovation. Companies that rely on loans to expand, invest, or innovate face higher costs, which can shrink their profit margins. This often results in reduced hiring, slower expansion plans, and even layoffs. The ripple effect can be felt across the economy as reduced corporate spending impacts suppliers, service providers, and ultimately consumers. Lower corporate earnings. With higher costs and reduced consumer spending, corporate earnings often take a hit. When companies report lower earnings, their stock prices usually fall. This can lead to a negative feedback loop where falling stock prices further erode consumer and business confidence. Lower earnings lead to reduced stock valuations, which investors respond to by selling off shares. This sell-off can be widespread, affecting not just the companies with lower earnings but the entire market. The resulting market volatility can make investors even more cautious. Stronger dollar, Saukos. High rates often lead to a stronger US dollar, which makes American goods more expensive internationally. This can hurt US exporters as their products become less competitive abroad. A strong dollar also means that foreign earnings are worth less when converted back to US dollars, further impacting the bottom line of multinational companies. This hurts companies reliant on exports and reduces their competitiveness. Exporters may see a decline in sales, which can lead to cost-cutting measures such as layoffs or reduced investment in new products and services. Reduced risk appetite. When interest rates are high, safer investments like bonds offer attractive returns. This can lead investors to move their money out of riskier assets like stocks and cryptocurrencies and into bonds or savings accounts. The shift in investment can reduce the capital available for startups and growing companies, stifling innovation and economic growth. Investors may pull money out of stocks or crypto and move it into these less risky options. This reallocation of funds can lead to a decline in stock and crypto markets, further exacerbating the negative impact of high interest rates on the overall economy. To understand the Fed's stance, we need to look at their main goal, fighting inflation. When inflation is high, the cost of living rises and the purchasing power of money decreases. By keeping rates high, the Fed aims to slow down spending and borrowing, reducing upward pressure on prices. While this benefits the economy in the long term, it often comes at the expense of short-term market stability. If you'd like to learn more about how to navigate volatile markets and build your wealth, check out the links below. For the Stock Smarts books and seminars are designed to give you the tools and strategies you need to succeed in the stock market and beyond. Even Bitcoin and other cryptocurrencies, which are often seen as independent of traditional markets, are feeling the heat. Despite their decentralized nature, they are not immune to global financial trends and economic pressures. Here's why. First, the speculative nature of crypto. Cryptocurrencies are highly volatile and their value can swing dramatically based on market sentiment and news. Crypto investments often rely on investor confidence and liquidity. When confidence wanes, the market can see significant sell-offs, leading to sharp declines in value. High rates reduce liquidity as investors pull money out of risky assets. This is particularly true for cryptocurrencies, which are seen as high-risk investments. Second, the stronger dollar effect. A strong US dollar can make cryptocurrencies less attractive to investors as they seek safer, more stable assets. Just like stocks, a stronger dollar can also make crypto less attractive as a pretenders and alternative investment. Lastly, institutional investment trends. The behavior of large financial institutions can significantly impact the crypto market. As more institutional investors enter crypto markets, Bitcoin and others behave similarly to traditional financial assets during rate-driven sell-offs. This convergence means that crypto is increasingly influenced by the same factors that affect traditional markets. For investors, high interest rates and their impact on markets offer important lessons. First, diversification is key. Spread your investments across different asset classes to reduce risk. Bonds, for example, may perform better in high-rate environments. Next, focus on fundamentals. Look for companies with strong balance sheets and low debt. These businesses are more likely to weather high-rate environments. And finally, maintain a long-term perspective. Markets are volatile in the short term, but staying invested with a long-term plan often leads to better outcomes. The question now is, when will markets recover? Markets typically rebound when interest rates start to come down. However, if inflation remains stubborn, the Fed may keep rates high for longer, delaying any recovery. It's important to watch the Fed's moves and economic indicators like inflation rates, employment data, and GDP growth. At the end of the day, navigating high-rate environments is about adapting your strategy. It's also a reminder of the bigger picture. Go where you're treated best, whether that's in your investments, your career, or your lifestyle. Always aim to live life on your own terms and make decisions that align with your goals. Thank you for watching this episode of Stock Smarts. If you found value in this discussion, make sure to like, share, and subscribe to the channel. And don't forget, check the links below for the Stock Smarts books and seminars to help you take control of your financial future. See you in the next video.